And thanks to everyone for joining this afternoon. As you can see, I'm with Eric Gregory, who's on our team, resides out in lovely Pasadena, California, and is a guru on capital planning. And John Clark, who resides in the Midwest in Chicago, has been on our team for a couple of years now, but he has a deep background in club finance, and he was the vice president of finance and administration, I believe, at Kemper Sports for a number of years. He's a CPA, and he's also a guru in capital planning. And we're very grateful for everyone. This is clearly a topic of great interest for clubs, and we're going to take you on a journey. Some of what you're going to see on the journey this afternoon and this morning, if you're on the West Coast, may be familiar, but there's a lot of new material here. And I will say up front, I think anyone who's followed our company knows that we're very mission oriented and very focused on education. And this is an educational webinar, although it does get into specifics of our Compass platform. And in some ways, I'll say right up front, maybe at the end of the 60 or 65 minutes, there's going to be about a 60-second sales pitch, but not more than that. It's only stems from the belief and the confidence that what we've created and discovered, it's discovered based on all the work we've done and all the analysis we've done, but what we've created in Compass is something that every club needs. So you've heard this before, I think, but I will remember this 2 or 3 week period of my life forever. But about 7 years after we started the company, over a 2 or 3 week period in late 2015, I remember digging into the balance sheets of clubs, because most of what we had done for the first 7 years of the company history was focused on the income statement. And I will say it's no coincidence, because that's the way the industry is. That's the way the industry is to this day. And when we began to dig into the balance sheet and the capital ledger, and they go hand in hand, as do the income statement and the operating ledger, we learned, and we've been on a journey of discovery for the last 7 or 8 years since that day, or those 2 weeks. And everything that we're going to present today is a result of the learning and the effort and the focus that Eric, John, others on our team, myself have made over that last 8-year period. Even with the benefit of the pandemic, this is the way the industry still shakes out. About a quarter of the industry is in what we would refer to as the red bucket. About a quarter is in what we would refer to as the green bucket, and the other half is somewhere in between. And really central to this distribution of the way clubs are at the moment is fundamentally the issues around capital planning and the strength of the balance sheet. You can see the biggest section under all 3 buckets here is the balance sheet deal, or the balance sheet details. And we have KPIs that can easily help clubs understand which bucket they're in. And it's all based on the research we've done. And I'll say this, if we were to fill in the blank, this is something Eric's done in some of his recent presentations. If we say clubs are in the blank business, what business? We could hypothesize, that's a rhetorical question on this webinar. A lot of people might say the dues business, which is a reasonable answer. We might say the hospitality business, which is a reasonable answer. But another answer that would be extremely reasonable is we're in the asset management business ultimately. This is some research that I did recently. I've been wanting to do this for a while, and I just found and took the time to find and categorize private clubs against the industrial spectrum, if you will, in terms of capital intensity. I've always had a suspicion that clubs are extremely capital intensive. There is a ratio called the capital intensity ratio. There's a couple of ways of calculating it. But when I put this slide together, we had 885 clubs that have submitted their data for the most recent fiscal year end. It's almost 1,000 now. This was about a month ago. And if you look at that in aggregate, there's about $10 billion of operating revenue and about $27 billion of property, plant, and equipment that comprise those 885 clubs at this time. So the capital intensity ratio is how much revenue is generated based on how much capital assets are invested in the business. The most intense capital intensive industry is the power generation and distribution industry, where you make investments that literally are in use for 50 to 100 years. So you generate incremental amounts of revenue and profit off of a massive amount of installed capital. Clubs are almost identical to the power industry. It's just a data point that supports the premise that clubs are a capital intensive business. So if we consider it that way, you know, really in the end, that capital intensity has to be recognized and has to be embraced as a key fundamental or a key attribute of the financial and business model of the private club. Clubs, if those who have followed these webinars have seen this before, I still believe this is the most important thing I feel like I've learned since we started the company. The blue line is the operating margin. So it's the operating ledger. The operating ledger doesn't include capital income or depreciation expense. 8 or so out of 10 clubs set the operating ledger, the income statement, excluding depreciation and capital income, to break even. And you can see at the median, again, data for the most recent fiscal year end. And that's now, this is 916 clubs. The median club literally breaks even. That's the case every year that we've been doing this. It wasn't the case during the 2 years of the pandemic because of the money that flowed in from the government. There was actually an operating surplus as a result. But we're back to where we were prior to the pandemic. And you can see about 70% of the clubs are operating in what we refer to as the break-even zone. And if it is a break-even proposition on the operating ledger, then by definition, it's not a financial driver. This is a critical point. When you, at your clubs, and we have GMs, we have controllers, we have CFOs, and we have a lot of board members in this webinar right now. But if you think about the intense scrutiny that the income statement operating ledger get every month in the finance committee in the boardroom, thinking that that's the financial driver, but it isn't actually the financial driver. The purpose of that money is to deliver the member experience. It's specious, it's consumed year in, year out by members enjoying the club. It isn't what propels the club forward financially. What propels a club forward financially is capital income and capital investment. It's the gold line, which shows capital income in relation to operating revenue. So that club that broke even at the median had capital income equal to 18% of its operating revenue. That's the free cash clubs generate. It's the capital ledger that generates the cash that clubs have to drive themselves forward financially over time. And that point is what has pulled us, and it literally pulled us into capital planning. And when we look at the average club's balance sheet, which you see here, this whole thing just snaps into place like a puzzle. And on one side, we have the assets that we own. In 70, I'm rounding, 75% of the assets a club owns end up on one line item, and that line item is the net book value of property, plant, and equipment. If you look to the other side of the balance sheet, how that's funded, 66% of it comes from the equity, the net worth, the book value, the retained earnings over time of a club. But as we just saw from the previous metric, that money flows from capital income. So what the equity or the net worth of a club is ultimately on the balance sheet is the sum total of all the capital income in the club's history minus the sum total of all the depreciation that's occurred And when we look to the left side of the balance sheet, it's perfectly symmetrical in that 75% of what we own ends up as net book value of property, plant, and equipment after depreciation. So this is the fundamental financial model of clubs. And we can see through the data how well clubs are doing at managing that asset base and how well clubs are doing at aggregating and investing the capital that's necessary. The net worth over time, as you know, is a metric we've discovered in that 2 or 3 week period I referred to in 2015. We've now charted it for 1,300 clubs since 2006. The way a club increases its net worth is if there's enough capital to overcome the depreciation expense. If there is, the net worth goes up. If there isn't, the net worth goes down. This is updated to include the most recent fiscal year. Things on the margin have improved slightly. The median was 2.4%. It's now 3.2%. That has everything to do with the money that was given to clubs by the government through the ERTC and the increasing initiation fees and member counts that have occurred in many of the clubs as a result of the pandemic and the follow-on demographic shift, which is a story for another day. But we believe for clubs to manage the assets that they already own, they have to grow the net worth at least 3.5% a year, which is about 45% of clubs have hit at that threshold through 2022. If you want to be able to not just manage the assets that we own, but add the aspirational assets that are necessary in terms of societal evolution, like pickleball as a simple example, then the net worth growth has to be at least 5% or higher over time. And you can see that's about 30% of clubs. So the vast majority of clubs are not hitting capital aggregation levels that are satisfactory over the long term. And that's why 3/4 of clubs are either in the red or the yellow bucket. Now, just to be clear, this is not in any way, shape, or form theoretical. This is real. This is bricks and mortar stuff. The change in net worth based on everything we just learned is simply this: year in and year out, month in and month out. It's the capital income minus the depreciation expense. And the reason that net worth has to grow is threefold. One, the book value of the book value, what's on our books, is less than the replacement cost, typically substantially less. And that is because what we used to call a capital reserve study measures what it's going to cost to replace the assets, some of which might be 20 or 30 years old today. So these replacement costs are significantly higher than the book value of the assets. That's point one. Point two, every club has assets that are fully depreciated, that are still in use, but will eventually need to be replaced. And the third point is aspirational capital investment is necessary. Clubs that don't put pickleball in or don't put casual dining or invest in casual dining, or clubs that let their irrigation systems or their mooring fields or dock fields wear out to depletion, they're in trouble. So we have to consider that matching depreciation isn't enough. We have to have net worth that's going to grow at a rate greater than the depreciation. So it isn't that we need to grow net worth. What it is if we're going to keep the assets fresh and up to date based on the 3 prior points, then if we're going to reinvest in that property, plant, and equipment properly, then by definition, net worth has to grow. That's the cause and effect. The net worth is an indicator, but the cause is replacing assets is more expensive than they are on the books. Our vision for Compass is this: every club is managing that operating ledger to a T. And we've seen it. We've monitored this for years now. Clubs do an unbelievable job of managing, monitoring, and producing that operating ledger through recessions, through pandemics, through good and bad times, to a break-even outcome. And everyone in the club, the management team and the volunteer leaders are pretty much dialed into assuring that happens. The capital ledger is the financial driver, but there is nowhere near the intense focus that exists on the operating ledger. But that's what we need. We need that same kind of focus. We need to know where we are capital-wise every single month, every single year, and it never ends. Just like producing the operating ledger or the income statement, that process never ends. It's ad infinitum. We have to do the same thing on the capital ledger, and that will result in healthier clubs, and that will shift the red and yellow bucket clubs in the direction of the green bucket clubs that have done the adequate capital investment consistently over time.
Ray, I have one quick question for you, please.
Please.
Where do you include debt service, principal and interest, in the operating margin calculation? Jonas excludes principal for this.
It's a great question. And at the moment, and we are going to change this, and I'm not going to get into all the technical reasons, but there's very sound reasons why we did this years ago. The interest expense at the moment is accounted for in the operating ledger, and the principal repayment is accounted for in the capital ledger. In the next few months, we are going to shift the interest expense to the capital ledger because that's the way most clubs do it. So it's a great question, but the data I just showed you shows the interest on the operating ledger and the principal repayment on the capital ledger. These are just examples of clubs. Well, the club on the upper left is a red bucket club. They have no capital plan or didn't over time, and you can see that year after year after year, their capital income was less than their depreciation expense. And that's a club that was stuck completely on the operating ledger. The yellow bucket club is a club where the capital income year after year after year matched the depreciation expense. Both those clubs, without any change in their processes or approach, are destined for being out of business. It's just a matter of when. The one with the declining net worth, the demise is sooner rather than later. The one with the flat net worth over time, they will erode into demise based on the rate of inflation. So it'll take a longer period of time, but eventually that club will get there because you can't just match depreciation for 30 years. Your assets will be worn out if that is the case. And it goes back to the 3 points I mentioned earlier. And then finally, there are clubs that have done well, and they could be green bucket clubs actually, but they have episodic planning. As you can see in this particular case, where you see the jumps in net worth as a result of assessments that come and go over time. And we are trying to change that approach into a more consistent approach that looks like our club that we use as the best in class example, the Country Club of Virginia, both for the magnitude of the growth of net worth and its consistency. That consistency is key. Capital planning needs to be a consistent, systematic, and perpetual process to match the consistent, systematic, and perpetual expense that's related to depreciation. Capital planning never ends. Capital investment never ends. And Compass is about putting the right software tool and the right process into the hands of clubs so that they can have outcomes that mirror what you see here from CCV. There's two types of capital investment, obligatory and aspirational. By definition, replacing obligatory capital is consistent and continuous because it just matches the continuous and consistent depletion of assets through depreciation. We believe that the income that mostly drives that should be also continuous and consistent, which is recurring capital dues. It's a faux pas. Every club's done it. But as we evolve and we learn and the industry evolves and learns, debt is not applicable for obligatory capital. I'm not going to get into why right now. Aspirational capital investment, by its definition, is more episodic. It ties to the strategic plan and the need to evolve the services and amenities in conjunction with the changes in society. It's more episodic, but it never ends. And therefore, initiation fee income and debt maybe more applicable because they're more episodic as well for aspirational capital. That's our framework that's at the heart of Compass. So Compass, in all we've learned, is intended to answer these questions systematically and constantly. And that is what we call effective perpetual capital planning. And the whole point of it is simply to assure that clubs aggregate the capital today to meet all of the capital hierarchy priorities tomorrow. And that's debt service, that's obligatory capital, that's aspirational capital, and that's increasing cash reserves over time. And with that, I'm going to turn this over to Mr. Clark, and he's going to take us through some of the details behind Compass in the process. Thank you, John.
I appreciate that. Thanks everybody for joining us today for this. And what I'm going to talk about, Ray, did you give me the drivability?
I think I did, but let me make sure. Yeah, you should be driving. So if you click on your slide and you hit the down arrow, it should move.
There we go. So what I'm going to talk about today is really the capital asset management tool we have, Compass, as well as the overall process, both the process with regards to the asset evaluation side and the capital planning side. The capital planning side, one thing I don't want to forget to mention is it's more of a cash flow based tool than accounting or finance tool. That's very important to the person who asked about debt, because we are able to schedule out existing as well as prospective debt according to the principal and interest terms that we want, along with cash flows from initiation fees or anything else that terms over time. So it's going to be a very comprehensive toolkit that you have at your disposal to work through. Here, there's a lot of information on this slide, but I'm going to really talk about two things. On the first area with regards to episodic and the reactive patchwork, and Ray talked about this, while aspirational tends to be episodic, it also tends to be industry-wise where a lot of capital was spent. Course renovations, outdoor dining, pickleball, things like that. But on the continuous side, under the proper planning, we want to ensure that everything else, your existing footprint, we like to call it, is getting attention. It doesn't mean that you have to spend the same amount each year. That's where the asset evaluation comes in. But we want you to be proactive with regards to where your investments need to be on a forward-looking basis. And that's why we believe Compass is a leading tool to help you do that. It makes you more efficient, it makes you more effective in how you're going to deliver a proactive capital plan and enhance the member experience for all your members. Currently, for a lot of clubs who aren't on the Compass platform, it tends to be siloed. You have a fixed asset register that resides within the accounting department. You may have a reserve study that primarily sits with a couple of people, and then around budget time, a capital planning spreadsheet may be utilized. It may link to the operating budget, it may not. What you're going to get with Compass is a comprehensive tool that breaks down those silos and brings something to you that allows you to see something holistically on how to address everything associated with the company and the club. Where this is really important is what Ray said in the beginning about the capital intensity associated with all clubs. We in the club industry, no matter what you want to say about your own capital, you are probably at the high level regardless of where your percentage may reside. And so being properly equipped to address those funding needs is going to be highly important for you. On the reserve study, this is one half really of the whole process, and where this is extremely valuable for a lot of clubs is this ability to understand your entire footprint in a tremendous amount of detail. And we have a few slides coming up that will address this. The capital reserve piece was co-opted from the HOA industry and how they do it. We don't feel it was applied properly to clubs when the old capital reserve study that other firms did and how they put it together. We believe our asset evaluation process is more in line with what your needs are, because it's looking at not what the existing expenditures are going to be, but we're also giving you a very robust and a robust tool that you're able to manipulate and change as your circumstances change. You may have a major project or amenity that needs work that you need to accelerate that was previously scheduled in 2026. Now it can be in 2024, or you can defer things that can maybe align with some aspirational projects that you have. And as you can see from the definitions on the terms to understand, you're going to get a lot of detail associated with that asset evaluation. The key things here are really in what I would call in the middle of the deck. Not only is it going to be to understand the member expectations, but you're going to have a building by building and room by room view of everything. A lot of fixed asset registers don't have that breakdown. That's how traditional accounting went. In fact, there are a lot of clubs out there that may just simply have building renovation and it be one line item in their fixed asset register. Through the Compass process and asset evaluations, you're going to get a room by room breakdown of all the costs associated with that. Where does that come into play and why would that be valuable? Well, for a lot of clubs that we deal with, they may be looking at major clubhouse renovations. And this allows them to prioritize areas of the clubhouse or areas of any amenity that they may want, and they have a good idea, at least of the obligatory costs, and it can actually help them plan on the aspirational side, because there are costs identified that maybe otherwise from an aspirational standpoint, the scope would have overlooked. The fixed asset ledger, the fixed asset register, has been something that not only in the industry is a weak link, but is a weak link as a CPA working over my career with over 20 industries. It's always a weak link. This is one of the most robust ways to look at it that I've seen in any industry I've been associated with. You are going to get a great deal of detail that not only goes above and beyond on the detail side of what you have, it's looking at replacement cost. It's looking at what you are going to have to look forward to or have to spend on a go forward basis, not reflected on the past values. If you bought something in 1995 or your club has something from 2005, that's heavily deflated to what it's going to be. This is a tool that's going to give you proper planning. It's going to be updated on a consistent and regular basis, so you have the most current level of pricing information available to you. And it's tailored as best as possible into your market. We may start with national pricing, but we're going to work towards getting you something that's very tailored to your club and your geographic area. This is just obviously on the screen, it's a lot to see, but this is basically the context of what you're going to see. It's going to have when the asset is in place, when the typical cycle of these items will be replaced. You have a level of control over that. An example is there are some clubs that might want to replace their golf carts every 3 years, others that may want to replace them every 5 years. So we're not going to cookie cutter this and say it must be X. We tailor this as best as possible to your circumstances so it meets your needs from a funding and planning process going forward. And an example where this current pricing is really important, and this is also important, as Ray said earlier, about the implication of book value versus current replacement cost. Many of you who have golf as part of your amenity package have seen the significant increase that turf equipment has experienced over the last few years. In addition to that, we also know that there have been supply constraints with regards to supply chain and so on. The Compass model is going to provide you up-to-date pricing based on the type of inventory you have, i.e. Toro versus deer. It's not going to be generalized. We are going to, again, tailor it as best as possible to your circumstances to give you the information you need. At the end and the summary of everything, you can see the detail that comes out, and it comes in this summary form. We've just, for sake of visibility, we've put it into how we put it into quadrants of every 5 years. The asset evaluation study is a 20-year study, and it looks at things that will cycle multiple times throughout that 20 years. So the grand total in this example of 41 million does not mean that you have replacement cost of 41 million. It's probably less, but it's at least what you could plan to spend over the next 20 years. We also build in inflation factors for you, and those inflation factors can be updated to your circumstances. An example of that is a lot of clubs will look at it from the standpoint of they still believe that inflation in their market will continue at a slightly higher than, say, 3% average long term. And so they can put in 5%, 6%, whatever over the next 2 or 3 years, and then revert back to the mean if we get to where on a macro level we believe will be long term. But as this shows, $41 million would be spent over 20 years, an average of a little over $2 million a year. At 671 full member equivalents, that would be $254 per month. That would be ultimately the best thing that you would be able to fund, but that means that over $3,000 of expenses per FME is basically sitting out there to be dealt with. And if you'll notice, a key reason for this, if you notice at the totals in the 4 quadrants, there's a significant amount of money in the first 5 years versus the 2nd through 4th quadrant years of your package. The reason for this is typically in almost all cases, because as Ray mentioned with regards to the industry, it has underfunded over the last 10, 15, 20 years. This is reflecting that catch-up capital. Now, the realities of funding that do come into play in the process, but it's very important to be aware of what is deferred. It gives you the visibility in a very detailed and data-centric way that you now have the ability to address it, because I would guess that most of you on the call today probably instinctively know that you have this or have some form of this. Now we're going to give you the evidence of how you're going to have to address those things, where it is, what the amounts are, and so on. And Eric's going to give you examples of how clubs did deal with this on a long-term basis, so they ultimately solved for this through the use of the toolkit.
I just handed control over to Eric. Eric, you there?
I'm here, Ray.
Okay. Hit that down arrow. Make sure that slide moves, please.
Okay, just making sure this is working properly. There we go. Okay, and good morning, good afternoon, everybody. I'm just going to make sure I'm getting to the correct slide here. Bear with me for 1 second. Ray, are you still in control, or have you passed that over to me?
You get 2 instantiations in there, so try again. Does it move if you hit the arrow?
It's not moving currently, Ray.
Okay, try this one. Hang on.
And over the pandemic, we've all been learning how to spell IT. Apparently not very well, though.
It is not. Try it now.
Okay.
Okay, I'll tell you what. I'm going to get you to where you were going. Right here.
Yep, we still need a couple more. But what I'll do is I'll go ahead and Ray, if you would just go ahead and advance the slides when I say next slide,
Yep.
we can do that. And like I said, once again, good morning, good afternoon. I think that, if you were on the first part of this call, a few of you may have had to wipe your monitors because you probably sensed the passion and Ray's breath on this subject. And, we're very passionate about this at Club Benchmarking for the reason that we've seen going through this Compass process has really made clubs stronger. So we're going to show you a few examples. But before we do that, what this really boils down to is after having that reserve study asset evaluation is developing a forward-looking capital plan. So let's go ahead and advance to the next one, please, Ray. So what we're trying to do here is we're trying to properly identify capital needs and resources and to develop strategies ahead of time as opposed to reactively trying to fix one particular issue. Sensitivity analysis is something that should occur frequently amongst the board as well as the management team. And go ahead and advance, please, Ray. So what we've created is a web-based platform. So with this web-based platform, the club can assign users. So you may want to assign, let's say, your GM and CFO. Maybe you want your president and treasurer to become users. You can make them read-write users, read-only. And we assign you a specialist from Club Benchmarking to facilitate the process. That process includes the development of your base case, up to 5 strategy meetings with a committee, and a membership presentation to approve the recommendations. Go ahead and advance, please, Ray. And let's go ahead and advance one more, please. So this is a quick look at our platform. I know that the text is very small, but we wanted to make sure that you could see that on the left side of that tab here are all of our inputs. And this is when we develop a base case for the club, we put in a tremendous amount of detail, particularly surrounding intake and attrition, transfers between categories, and or refundable equity if you do have refundable equity. We've built loan tabs and assessment tabs that are very detailed and advanced, that are specific for private clubs. As an example, if you're using spreadsheet management, which most clubs do, and you're trying to put in a loan in Excel, you're basically allowed one type of a loan. We've actually built several different types of loans that you can use, including construction loans, where you can build in your drawdown schedules and your number of months of interest only. You can see here, this is just an example of our pro forma or our cash flow schedule. As John mentioned before, this is all based on a cash flow needs. Go ahead and advance, please, Ray. And you can see here, this is just a little bit more detail on the cash flow schedule. Please advance. This is a look at one of our charts. So we're now, we've moved everything over to Microsoft Power BI to be able to print reports that we believe you can put in front of members without having to be experts on club finance. This is an example of looking at a base case and a strategy and the difference between funding obligatory capital and what the club's capital dues line is. We, of course, see this as a base case, as John mentioned, a best-in-class example, as John mentioned before. Let's go ahead and advance, Ray. And we're going to take a look now at 4 different clubs that have gone through this process. We're not going to use the name of the clubs, but I know that we do have a few of the board members that are on the call today. But these are 4 recent clubs that have gone through the process and have made some meaningful progress, at least in our opinion. I hope the clubs would agree. And let's take a look at the first one, please, Ray. So the first club is a developer turned member-owned golf club, and that occurred fairly recently. You can see here that this is a pretty high initiation fee club. They have operating revenues of 11 million, initiation fees of 100,000. Operating dues are on the higher side as well. The club had no capital dues. You can see here when we calculated the compound annual growth rate for this club, it was actually negative. And part of the reason for that is because nearly all of the initiation fees were refundable upon selling membership. And that left very little in the club's capital account. So the club would budget for an annual operating surplus to fund the book depreciation as well as any debt that they had on the books. When we came in and did the asset inventory, it highlighted obligatory capital costs that were significantly above the book depreciation expense. And when we did the base case model, it showed a $7 million funding gap just to cover the replacement schedule and the existing debt. So let's take a look at the next one, Ray. So we'll just look at the sources and uses of funds. This is one of our reports in our Compass program. And you can see there's a $7 million difference between the uses and the sources that the club had available. And let's take a look at the next one and talk a little bit about strategy. So the first thing that the club wanted to do after going through the process and having the strategy meetings is they wanted to have a separation of the operating and the capital fees at the club. So the club had basically one dues line, and after going through and evaluating some of the best practices, they decided to separate those out. And so what they did was they actually reduced the operating dues component and then separated it out and put in a capital dues component. So the net increase to the member was $110 per month. But what that meant is that the future years, we wouldn't have to do a capital dues increase unless we had new assets installed, because inflation was already built into the replacement schedule. The club was able to reduce refundable equity in working with the developer in lieu of doing a one-time membership assessment for replacements as well as some aspirational projects. So what that meant was that all future initiation fees, net of any refundable equity, would be used for aspirational projects. And they did have a few that were identified as important by the membership. So the new strategy funded all the obligatory replacements as well as $4 million of improvements. And you can go to the next one, Ray, where we can see the sources and uses once again. And you can see there's the addition of the aspirational $4 million of improvements in that model as well. And one thing that's important when we do these strategies and we're working with clubs is we always want to put the club in a cash position that leaves flexibility for future boards. So even if there isn't an aspirational project specifically identified, we want to have that flexibility to be either A, pay down our debt on a quicker schedule, B, write out market conditions that we didn't anticipate, or C, start to build for the next future project that may be coming along the pike in the next 5 to 7 years. So we'll take a look at club number 2. And club number 2 is a city and athletic club. It's been around since the 1920s. You can see operating revenues of 12 million, high initiation fees of 95,000. So this is a club that was, I would say, in the yellow to green bucket. And what they were trying to do is really move away from one-time membership assessments to get projects passed. You can see there, they had no capital dues in place. The compound annual growth rate was 4.3%, so certainly not bad, but all of that growth occurred with assessment cycles or COVID spikes. So it was like Ray showed before, where you saw that episodic approach and we saw the net worth going up quickly and then coming right back down. The net to gross property, plant, and equipment ratio was on the decline each year, and the base case model, when we put in a necessary clubhouse renovation that the members had already voted for, it showed a $6 million funding gap. So we'll take a look at the sources and uses there. And you can see there that we had $10 million in sources, 16 million in uses. And when it came to strategy, go ahead, Ray. They implemented a capital dues of $120 per month per full member to fund the replacement schedule. As they were putting in the new aspirational projects, which were totaled at $10.5 million, they forecasted an initiation fee increase of $10,000. And what we saw is that no members left the club due to the implementation of the capital dues. Essentially what they were doing is creating a more of a pay-as-you-go program as opposed to a periodic and sporadic assessment. So let's take a look at the sources and uses, and we can see there the sources and uses of funds. This club did start with a fair amount of cash on hand, so they were in a position where they could certainly put themselves some flexibility. So club number 3 is going to be a club that was another developer turned member-owned club, and that happened also fairly recently. You can see there that this club was not a high initiation fee club. This is a low initiation fee club. They had capital dues of $40 per month. You can see that the net worth is essentially flat. and they were using initiation fees and their very small amount of capital dues to fund the club's needs. And their base case model showed a $6 million funding gap to cover the replacement schedule. You can see there that the uses of funds outweighs the sources by $6 million. And when it came to strategy for club number 3, go ahead, Ray. They actually wanted to approach this in 2 phases. They wanted to approach this in phase 1 was, what do we absolutely have to do to meet our fiduciary duty to protect and grow the assets of the club? And phase 2 was, what would we really like to do in terms of aspirational projects that the members have identified in their studies. So phase 1 increased their capital dues by $52 per month per full member. They then did a $10 increase annually until the current schedule was fully funded, and that number was $170 per month. They also decided to take out the food and beverage minimum. Now, this is a little bit controversial sometimes at clubs, and we're not saying we're going to repurpose that fee, but essentially what they told their members was, we want to take the mandatory fee and make it lower in this aspect. However, our greatest need was really funding the capital. So the club was able to take the unspent minimum portion, account for it on the operating ledger. And so it's a little bit of a give and take there. So that was put in by the club. It did not require a vote. However, there was a fair amount of education that went to the members as part of the process. Subsequently, the club went to a vote of the members to approve an additional $20 per month in capital to take care of a $2.2 million dining expansion project. That project was voted as important by 85% of the membership in their survey, and they did forecast an initiation fee increase of $5,000 tiered up over a couple of years following the renovation. And that dining project was then approved by 79% of the membership, and the club experienced no attrition. I want to venture to say that had the club not gone through phase 1, which is what the club absolutely had to do to fund the replacement schedule, phase 2 would have been a much more difficult to be able to accomplish. And let's take a look at the sources and uses there, Ray. And you can see that this club is actually building a fair amount of aspirational cash balance or flexibility in their model for the future as well. And our final club is also a lower initiation fee club. This is a member-owned club that was founded in the 1960s. It's a smaller operating revenue club. It's a low initiation fee club. This was a club that was definitely in the red bucket. You can see that the capital dues that were in place were at $30 per month. The club had a declining net worth. The club's net to gross PP&E ratio was under 30%. And they were using initiation fees and their very small capital dues to fund their needs. Their base case model showed a funding gap, which we can see there in the sources and uses. And once again, in terms of strategy, this club actually decided to also approach this in 2 phases. So phase 1 was taking the capital dues and essentially getting to the amount that they needed to fully fund the reserve study requirement, which was $120 per month per member. This club decided to do an increase on top of that because their initiation fees were very modest. And even though they're projected to go up, they wanted to build some aspirational cash. They also decided to remove the food and beverage minimum at the same time. The club did experience attrition from 1 member. However, that member was the most vocal critic. And when it came to the second phase, the club is currently going through putting it to a vote, which is a $4.5 million dining project, which is projected to net 100 new social members over the next 4 years. And because of that, and the fact that the additional social members will be coming in to fund the club, the net difference to the golfing member for that vote is going to be $35 per month for that $4.5 million project. So as we look at some of the key takeaways, and go ahead to the next one, please, Ray. And we'll go ahead to the next one as well. So when it comes to funding obligatory capital, a couple of common themes that we've seen is number 1 is having that asset evaluation or that capital reserve study. It can help to calculate what every member's share of funding the replacement schedule is. Many clubs, because that number can be so large if you have a lot of deferred, They want to start with a smaller amount in capital dues and tier up that fee over time, understanding that doing so may limit the aspirational investment, but every club is going to have to make choices. Educating the members on that deferred maintenance is absolutely essential. I've seen a lot of great presentations where clubs will use pictures, they'll tour members, they'll show them areas of the club that they've never seen before. And once members see these items that are completely deferred, that are breaking, they say, we've got to do something about this. The separation of operating and capital dues, we definitely see a lot of clubs moving to that as opposed to just having one dues amount. We believe that it's the most transparent way that you can do it in a member-owned club. It also allows you to properly benchmark your club's fees and your dues versus the industry, and it allows you to make annual increases separately because we know they move at a different pace. We have seen a lot of clubs are repurposing their food and beverage minimums and just saying we're going to put in a capital dues program, but we're moving away from F&B minimums. Of course, there is some unspent minimums that you do need to make adjustments for. Typically, we see that on the operating ledger. And as Ray mentioned before, we don't see that debt as an effective tool for capital replacements. We think that debt should be reserved for aspirational projects. Those have a rate of return in the form of additional capital income, and the Compass program can help identify that rate of return. When it comes to funding aspirational capital, what we've seen is that clubs that put in a capital dues line to fund the replacement schedule, now things get a little bit easier because you've got initiation fee income that's specifically reserved for aspirational capital growth. And what we find is that many clubs find this an easier ask because we don't necessarily want to ask the member that's in their 80s to fund the new, let's say it's the new fitness center. And maybe we need the new fitness center to attract the 40-year-old member, but the 80-year-old member doesn't want to pay for it. And that certainly makes sense. So rather than doing it that way, what we're asking members is let's pay for what I'm consuming on an everyday basis in the form of recurring capital dues, that pay-as-you-go program, and let's let the new members pay for the new projects in the form of initiation fees. Obviously, any new aspirational project should see that rate of return with higher initiation fees and or additional membership growth if the club is looking for more members. Of course, if aspirational goals are greater than our projected capital initiation fee income, we saw that with club number 4, the club may have to consider either taking on debt, possibly membership assessments, or additional increases to the capital dues. And with aspirational capital projects, one of the things that we see that is controversial is if we don't have that data, if we don't have a great membership survey where we've asked our members what they're looking for, if we haven't done a facilities master plan, if we haven't done a strategic planning process, then that can absolutely be controversial with our members. Funding depreciation, what we found, is not a very controversial topic with members. However, if we haven't done that data and diligence with aspirational projects, they can be. And of course, aspirational projects will likely result in a lower replacement schedule in the short term. However, we do have to add those new assets to our replacement schedule, and we will see those numbers start to pop up later in our capital reserve study or asset inventory. So Ray, I'll turn it back to you.
Thanks,
I have
Eric.
a question or two that was for Eric that I think he probably addressed, but let's just make sure. One is, what is Eric's position on the use of debt to fund capital deficiencies? Eric, you just want to reiterate that one?
Yeah, I think that, we believe that when it's capital deficiencies, I'm assuming that is replacing an existing asset that is fully depreciated. Our position on that is not a best practice. The reality is that some clubs don't really have a choice. But if we're taking a look at this proactively, we want to use debt for the thing that has the rate of return, and that's going to be an aspirational project. We don't want to ask a future member to pay for something that has been fully consumed already. So we prefer to see debt use for aspirational projects. And Ray, please feel free to add to that if you like.
Yeah, and I'd just say in general, and it's one of the most frequently asked questions we get is how much debt is too much debt. But just in general, if a club did a perfect capital plan If a new club formed today and started with these best practices being embraced, and it conceived and implemented a perfect forward-looking capital plan, as long as it kept it dynamic and kept updating it as society evolved and as the wants and needs of the membership and prospective members evolved, you could project forward any aspirational investments, and theoretically, you could build a club and manage a club over the long term without any debt. Debt is only a proxy. It's a bridge. It's a temporary proxy for injections of capital from the members. But of course, it'll eventually need to be paid back through capital infusions from the members. So the reason that there's a lot, let me put it this way. Much of the debt that exists in the industry is misplaced, and it's indicative of the lack of comprehensive forward-looking capital planning. And that's just the reality. We're not saying never use debt. There is, as Eric said, there's reasons that we could conceive. But for the most part, debt can be mitigated or completely managed by implementing a comprehensive forward-looking capital plan. And with that, maybe this is a 60 seconds of the sales process to a degree, but this is what Compass is. And that true north in our logo has meaning. And the meaning is, if you really want the sustainable financial outcome in your club and you want to manage the feelings of members over time, the key to it is comprehensive capital planning. Members should know, even before they join a club, what they're signing up for. They should understand that the club has capital needs and it never goes away, and that the only way any business raises capital is from their owners. Debt is, again, it's just a bridge. So we've concluded, and the reason that we've developed Compass, and frankly, the reason it's been so successful thus far, is because two things. One, all that we've learned from this data that we just presented about how important capital is and how capital is the financial driver of the club, not the operating ledger. All that learning didn't exist until 5 or 6 years ago. We discovered it. It's new. It's like any innovation. It's like a smartphone. They didn't exist 20 years ago. Now we can't live without it. Okay? So the knowledge that made this so important was missing. It's not missing anymore. It's there and it's real, and we got over 400 people here listening to how important it is today. So that's the first point. The second point is, in the absence of the knowledge that it's so important, there was never a platform developed, an application-specific platform that was developed to allow for this process to be done in a consistent, systematic, and perpetual manner. We created the platform. That is what Compass is. We're filling a need that exists in the industry. And so the knowledge plus the tool and plus a process that's never ending, a perpetual process, the constant updating replacement costs, the constant updating of useful life, and the constant updating of our asset inventory, those plus the platform are what effective capital planning is. So the number of clubs that are on the call today represents the distribution of red, yellow, and green bucket clubs. And any club that wishes to change its fortune into the green bucket, and I'm saying this with a lot of confidence, but it's only confidence founded on true analysis and study. The only way you can move to the right is through more effective capital planning. There is no other way. We can't cook enough hamburgers to do it. We can't have enough weddings to do it. We can't do it using debt. We can only do it systematically by getting our arms around managing this capital intensive business that we are. So in summary, to keep this simple, effective capital planning is the root of financial success, and that is a period. And Encompass is an application-specific approach. It's software and process that enables effective capital planning. The median club of all clubs in our database, the median is a club that has, and this is clubs with and without golf, has $25 million worth of gross property, plant, and equipment. And at the median, those assets depreciate at 3.7% per year of that 25 million. And so the whole point of Compass is to get our arms around that so that we aren't driving the club over time in the negative direction. We are driving it over time in the positive direction, systematically, methodically, and incrementally, so we don't have to reach into the members' pockets every 8 years for 20 grand or 15 grand through an assessment. We do it incrementally over time. It's much better for everyone. And I will say this, time is of the essence always. When there's deferred investment, and there is in 75% of the clubs in the industry, the longer we wait to tackle it, the harder it becomes to tackle it. Because the deferred number gets so big, it's problematic. As Eric had said, and John had said, and they've been deeply involved in many, many clubs and many, many discussions. One thing I have an appreciation for is it's amazing how members know when the leadership of a club has done it the right way. When data and diligence are applied, members note it, and it makes things much easier, and it results in votes of 7 in the first digit or higher. Okay, lack of data and diligence are also noticed by the broad membership. So this is all about diligence and being systematic. It's not about that episodic approach. We have a new president, we have a new treasurer, we have a new GM, we have a new CFO, and all of a sudden something's going to be different for a couple of years, and then we're going to go back to where we were. This is about embedding a mission critical process into the day-to-day and month-to-month governance and operation of the club. And so in the end, and this is the 60-second sales pitch, I suppose, but a lot of clubs are formulating their budget for next year. You get at the median, you got $25 million of gross assets. So it would make sense if you start to consider putting the platform and process into your budgets so that you can start to manage those assets proactively and systematically. And with that, it's 3:03. If there's any questions.
I do have questions, and I'm thinking those of you that can stay on, let's try to answer these live, because that puts it on the recording so that when I send that out, everything will be there intact for those who listen later. We had a number of people today say they got, double booked and weren't going to be able to join. So thoughts on issuing member capital certificates refundable upon resignation for a method of raising substantial funds for a capital project versus an assessment non-refundable?
Well, it's a reasonable thought, but we'd have to understand the specific circumstance. But capital can't go in and come out. A club needs a certain amount of capital, period. And it has to be there. One of the biggest detriments to many clubs that were, let's say, developed in the 20th century, in the 1980-90 timeframe, was when the developers, and Eric and John both addressed this, when the developers turned the club over to the members, there was a lot of refundable equity, as everyone knows, in many of those clubs. It's a very similar situation. Refundable equity was the nemesis of clubs in proper capital planning. It's a negative. So I would suggest, I don't know the detailed circumstance, but I'd suggest that concept of refundable capital infusions is not something that will sustain itself over time by definition, because we need the capital for the assets that we own, and we can't, put it in and take it back out because we won't have enough capital.
I would agree with that. I'm dealing with a lot of clubs who are facing that, who had that refundable capital, say 20 years ago, thinking, oh, that's 20 years in the future. Well, now the piper is now calling and they're having to deal with that refundability, and it's impacting their ability to use incoming capital for capital investment, and it's having to be refunded to members who will no longer be using the club.
Any
Okay.
others?
Shifting gears, a quick one. How are lease versus buy decisions considered? For example, a $100,000 fairway mower. I think that was
Yeah.
during Eric's session, but you guys
That's a
decide.
good question. We build leases. Leasing or buying is just a form of financing decision. It doesn't negate the capital need. So we consider, when we do asset assessments and on-site assessments, we put leases into the capital budget. So we just plan for them in the cash flow related to them, just like you would if you were purchasing it.
Okay, I have a couple people asking, that's point blank, what is the cost of the Compass program?
That is point blank. Thank you. Yeah, to get a sense, for an average 18-hole country club, which is roughly $25 million of gross assets, gross PP&E, it's a $6,000 setup fee to get the team on site, do the asset assessment and inventory and all the replacement cost analysis, and set up the capital modeling situation and get through the capital modeling. Just as Eric said, the base case and the strategies. That's a $6K setup fee, and then it's $12,000 year 1, 2, and 3 for the software platform. We're asking the initial clubs to commit to 3 years, and we believe after that it will be something that clubs will use perpetually and just build that price into their budgets, and that's what it is for an average 18-hole country club. It's higher for clubs with greater assets and less for clubs with smaller assets.
Okay, I have a couple questions from Club Essential clients. Does Compass have an API interface with Club Essential? And the other variation on that question is, we use Club Essential. Does Compass interact with Club Essential entries, or is it is record keeping separate?
We are in favor of APIs. Compass will have an API. It isn't running at the moment, but it will have an API, and we do believe that over time this thing will have to be integrated with other management software platforms. So yeah, we will support that over time. And the question of what part of it integrates with Club Essentials and what data, that's a probably detailed discussion, but yes, in general, we support that concept.
Okay. I had one more in here I wanted to do. Did the fairway mower. What level of review scrutiny is typical from boards over their club's annual capital expenditure plan?
Well, Eric will probably want to add to this, but I'd say this. Most of the capital planning in most clubs today, as a result of where the industry has been, is a triage process, meaning the management team comes to the board and/or finance committee with, I'm just using random numbers, $2 million of capital needs for next year. And the finance committee and board are the paramedics on the side of the road triaging the 2 million and saying, well, we only have 900,000. So let's go through a triage process of prioritizing our capital investments. Prioritizing capital investments in the wake or in the face of inadequate capital income is an indication of the need for proper capital planning. So that's really the way it works most of the time now in clubs. We're trying to shift that so that clubs don't have to go through the triage process because of inadequate capital income, but they can meet the needs they need because they have adequate capital income because they've projected forward proactively and precisely, and they've asked the members to cough up the capital that is ultimately necessary. We're trying to break the cycle that's existed in this industry for way too long. We know we can break it because we've done it with well over 100 clubs now. It can be broken. It must be broken.
Okay, period. here's another one, and I know there's a lot of people on the webinar that are in this situation. What's the price for the software platform if we've already completed the study and financial modeling?
Yeah, that's a great question, and that we'd have to take on an individual basis, but we're happy to do that with you. It depends on when the reserve study or the on-site was originally done and things like that, but it's something that we obviously are in the process of doing, is shifting anyone we've done this work for into the Compass program, because we want everyone in the Compass program, because we're out healthier clubs.
Right. Okay, I think I got through everything. If I missed somebody, we'll review the posted questions and get to you by email afterwards. We've still got well over 300 people hanging on here, 10 minutes late, so thank you so much.
You thank everyone for their time. Thank you, and we look forward to working with you. Thank you, Terry, Eric, and John.
Thank you, everybody.